Hi, good morning. I'm gonna start making I'm making a YouTube channel, and in this channel, I'm gonna be speaking about everything that interests me from finance, economics, business, real estate, and anything else. So I want to start off by talking about the world economy and monetary policy more in particular. So I want to make a claim. I think the world today is in a monetary policy trap. Now, why do I say this? Is because every single major central bank of the world is forced to keep its rates at zero or near zero or negative. From Bank of Japan, England, the American Federal Reserve, or the Australian banks, or Euro, or whatever. Okay, and they're facing downward pressures to keep their rates at zero. And if any one bank increases rates as compared to the other, you will see a flush of capital going from the other countries into that country, and will further destabilize that country's economy. So I feel all these countries are facing this. Now, why did this happen? So I want to go back into the history of this and give you a brief history. So in 1936, Keynes introduced the idea in his book, General Theory of Employment, Interest and Inflation. Introduced the idea of contractionary and expansionary fiscal and monetary policy. He said that governments should intervene whenever there are recessions in order to counteract the effects of recessions and stabilize the economy and further move it towards full employment. So he promoted the idea that whenever the government sees a recession, to reduce the rates of interest, to increase the amount of money that is available to the economy. And when you reduce the rates of interest and more money is there in the economy, that will further expand the economy and stabilize it again and counteract the effects of the recession. So going back to 2008, Ben Bernanke in 2008 reduced I think in 2008 or 7 or 8, reduced the federal funds rates to 0.25. He did this so that it would boost consumption and spending, because federal funds rates affects rates of a lot of other things like property rates, property rates, the equity rates, credit card rates, property mortgage rates, and further he also did quantitative easing through open market operations by buying back bonds from the banks and giving money to banks and taking bonds from them, so that the banks would further be motivated and incentivized to lend into the economy and find businessmen to lend to. Now, to some degree, this has worked because what has happened is that we've seen that employment consumption boosted. We saw that unemployment reduced to I think all-time highs, partially because of the labor participation rates. Unemployment reduced in Britain also. So it worked to some degree. It stabilized the world. It didn't go into depression. But to some degree also it hasn't worked, where we saw that the savings ratio increased. What happened was that instead of when you have zero or negative interest rates or very little interest rates, with people's insecurity because of the Great Recession, people started saving even more. Instead of spending more, they needed to spend more to secure themselves. With higher interest rates, they can save less and secure themselves. But with lower interest rates, they have to save that much more in order to feel secure, because their money is bringing them that much less return, or the FD rates are so low. So they have to save that much more in order to secure themselves 10 years, 15 years, 20 years down the line. We saw savings ratio increase. We saw net interest margins across the world in all banks compress. And because of that, that also leads to risk-seeking behavior of banks, because then they're trying to increase their net interest margin. They're starting to invest and lend to riskier assets and taking riskier decisions. And also thirdly, we saw that there's less monetary space available for countries to counteract any future effects of recessions, or create any future the tools available. The monetary tools will become partially redundant if it does not create some monetary space. Keeping this in mind, I think in the long run we really do require, maybe not in the short, but in the long run we definitely do require a higher rate of interest to keep that monetary space. But it'll be interesting to see interesting to see how this happens, because if any one country increases rates as compared to the other, there is a carry trade, and the other country takes the money from people from the other country, take the money from there and put it into the country with the higher rate of interest. So it'll be interesting to see, because this is really, as all economists have been saying, uncharted waters. Never has the world seen such low interest rates. So it'll be interesting to see, but what is for sure is that we need, in the long run, we need some monetary space to counteract future recessions. So yeah, thank you. That was my first thought. Thanks.